we want to get a broader perspective on how to invest. And Haag Sherman is Chief Executive Officer and Chief Investment Officer over at Tectonic Holdings. Now, he is a big deal in the energy space. He manages about $6.7 billion across all asset classes, not just energy, but he was the guy that you go to for this kind of energy advice and energy investing. Haag, it's great to have you. Thank you for joining us. There's a lot to talk about. What is foremost on your mind when you think of investing specifically in the energy space?
Well, I think foremost on my mind is really the consolidation that's going on in the industry. So if you look at both oil and natural gas, you have some major transactions that have been inked. You just mentioned one, which is the Chevron Hess deal, which is being attacked effectively by Exxon based on their right of first refusal on the Guyana assets of Hess. But you also have in natural gas, you have the Chesapeake Southwestern transaction, which is similarly very interesting. So I really think this is the central thesis of energy, which is we want to have more scale in the basins in which we operate because we're really in the manufacturing business. We're manufacturing molecules. So scale, operational efficiency, and inventory matter.
Hey, I hear, I have a lot of buddies from my Payne Weber day. I know you were there, David Bradshaw and a bunch of other guys that were in the energy space. What I know is from them, E&P was the fun sector to cover there for a while. But I get the sense that these E&P companies aren't doing too much E these days. They're just kind of in production. Is that the case, and why is that?
Good question.
That's exactly right. So if you look at historically, as we grew up, especially here in Houston, the E was kind of the glamorous part of E&P. I mean, you had these great offshore projects. You had, these frontier projects, the North Slope, when Russia opened up. You had the Sakhalin Island. You had Kazakhstan, and you had other projects. And this was really the glamorous part of the industry. And our oil and gas companies were intrepid. They would invest, but they also had a long time horizon. Today, that time horizon is much, much shorter. With the onslaught of renewables, the executive teams of these big E&P or these big energy companies are more focused on delivering short-term investor returns, delivering cash back to investors. They don't want to take duration risk. So they're really focused on becoming manufacturing businesses with good core holdings and good inventories of areas of current operations.
So how do you invest in that when they're becoming a different type? It's becoming a different type of industry in essence.
Well, I think you really focus on those that are best at manufacturing the molecules. I think Exxon is an excellent, and they've really been on this trend for quite some time. They had a big 2019 initiative to cut costs and really become more efficient. EOG is another kind of a mini Exxon without the downstream operations, very efficient. They understand that this is about inventory, unit level cost, unit level productivity, and economies of scale so that they can deliver the best return possible to their shareholders.
Hey, so you're right there in Houston, the center of the U.S. energy business, maybe the global energy business, I don't know. Talk to us about renewables. How committed, to what extent are U.S. energy companies kind of committed to renewables? Because some of the rhetoric coming out, I don't know if it's just politicians or others, or I'm just not sure. It seems like it's more commitment out of some of the European energy companies.
And I think that's right. I think if you really look at the big integrateds in the U.S., there are certain areas that they're focused on, carbon sequestration and other areas. But to their credit, they've been focused on what their core competency is, which is producing hydrocarbons. And if you look at Europe, which you brought up, BP's under a lot of pressure now for abandoning hydrocarbons, or at least de-emphasizing hydrocarbons. So I really think that the U.S. energy companies got it right. But we have other areas of investment, particularly here in Houston and Texas. Texas is a U.S. leader in renewables. We have great private equity supported the industry here in Houston and throughout the state and really throughout the country. And so we're getting that built out independent of our E&P companies or our energy companies.
So Haag, as I talk about how to invest, it's really going to be private equity, it's government money, and it's oil companies. Like those are three buckets that I see that invests in the energy transition, not just straight renewables, but the energy transition. What in the energy transition do you like the best? There's so much money that's going to be wasted on stuff that doesn't work. What do you like?
It's a tough space to navigate right now, because if you really look at kind of renewables right now, and really over the past couple of years, it's really like the shale boom back in, call it 2013, 2014, 2000, before it crashed, because there's a lot of money that's coursing in. Prices are inflated. So to me, it's really an area that you have to be careful in, and that's why I like, fossil fuels better at this moment than energy transition, just because I think the prices are better. And if you're a share or an investor looking for returns, you want to go to where you can get the best returns. So I've shied away from renewables, really focused on traditional fossil fuel energy, but the day will come when those will become more investable, in my opinion.
I'm looking at this chart for natural gas. What happened? Holy cow. Things cratered. I thought people liked natural gas.
People like natural gas, and consumers like cheap natural gas.
Yep.
It's not great for producers, but it really is. It's a stunning collapse. I mean, if you look a year and a half ago, you were at $9 per MCF. Today it's $1.80 or thereabouts. And so it's been a stunning collapse. A lot of it's weather driven. You had a big LNG facility that was offline that really started, it was a catalyst for the current downdraft. And right now, we can talk about natural gas being a global commodity, but right now it's still largely a domestic commodity. So we really don't have the global support until we start opening up more LNG facilities, which will happen in 25 and 26. If you look at the curve in 25 and 26, it's more constructive, although it's not great.
So, but to that point, I mean, with natural gas prices at this level, are they economic for producers and for LNG exporters?
For producers, it's tough. So, I mean, a lot of them are hedged. And so, for example, I think Chesapeake's 44% hedged.
Okay.
So a lot of them are hedged in a higher price environment. And so they're still getting by. But if you look at really what Chesapeake announced last week was, we're not going to invest as aggressively in the space. And so that created a situation where natural gas got a modest bid, but all the energy companies in natural gas saw their stocks rally. There has to be this sea change within natural gas production where rigs are laid down, and that'll happen to a certain extent through consolidation. That's why the continued consolidation in the industry, taking privates out because they've been more active with the drill bit, and public companies have certainly been more disciplined than private companies as it relates to producing or drilling wells.